Hello everyone. In this video, we're going to talk all about taxes. To get us started, we're going to take a look at the US federal tax revenue sources back in 2017. Total tax revenue in 2017 was about $3.3 trillion. The major sources of tax revenue for the US government are going to be the two payroll taxes, which are deducted from workers' paychecks. These are individual income tax and social insurance or Social Security and Medicare tax. In 2017, these two categories accounted for about 83% of all tax revenue. And the other major sources of tax revenue, which are going to include those corporate taxes, estate and gift taxes, excise taxes on particular goods like gasoline and cigarettes, and customs taxes, all added up together only contribute about 17% of US federal tax revenue. Social insurance tax is money for Social Security and Medicare that comes directly from people's paychecks. Currently, these are about 15.3%, and this is split in half. So you pay half of this tax, about 7.65%, and then your employer pays the other half, which again is about 7.65%. Self-employed people will pay the full 15.3%, and the benefits received by each retiree are going to be dependent on what they paid in during their working years. US federal income taxes are set according to a scale that increases with income tax levels. So progressive income tax system is what we call this, and this just means that people that make more money are going to pay a larger portion of their overall income in taxes than people with lower incomes do. That marginal tax rate is just the tax rate paid on an individual's next dollar of income. So whenever we talk about marginal thinking, that's just each additional unit. And for taxes, that just means that it's a tax that we're paying on each additional dollar. Now, keep in mind, something that's very important to consider is that in a progressive income tax system, these increase with higher earnings. You're not going to be paying that higher tax on all of your income. You're going to be paying it on the portion of your income that is over that threshold. The average tax rate is just the total tax paid divided by the amount of taxable incomes. So lower brackets of your income are going to be hit by lower marginal tax rates, while higher brackets of your income are going to be hit by those higher marginal tax rates. This slide is figure 15.6, and it shows what the US federal tax rates were in 2019. Now, these tax rates are marginal tax rates, which means they apply only to dollars within those specified income ranges. So, for example, all income earned between $36,901 and $89,350 is taxed at 25%. But if somebody earns $89,351, that last $1 would be taxed at the 28% rate. This is something that a lot of people fail to kind of recognize when they're calculating taxes and making decisions on whether or not they should accept a raise. And you need to keep in mind that these are marginal tax increases, meaning that those increases in income will only be taxed as high as the bracket that they're within. And it's only that additional funds that will be taxed at that higher rate if you do bump into a new tax bracket. So taking a look at some historical income tax rates, US income tax is only about 100 years old, and the highest marginal tax rate was in 1913 at about 6%. This was applied to earnings that were over $500,000, which technically would be worth about $11 million today. Marginal tax rates were going up pretty quickly, and the top marginal rate in 1918 was 77%, which applied to anyone that made income over $2 million. The highest top marginal rates occurred in 1945 at 94%. The first big cut was made in 1963 by President Kennedy and was then followed by President Reagan in the 1980s. So prior to 1913, most taxes were generated by import tariffs. And in 1913, the passage of the 16th Amendment allowed the government to go ahead and collect an income tax. The 6% marginal tax rate only applied to people like Henry Ford, Andrew Carnegie, and John Rockefeller, so people that were making quite a bit of money. And by 1918, that top marginal rate rose up to 77%. And again, this was only applying to people who had income over $2 million, but it meant that every dollar earned beyond 2 million yielded only 23 cents to the income earner. That's why there had to be some litigation that changed those taxes and cut them a little bit. And that's why President Kennedy and President Reagan adjusted those taxes. On the next slide, we're going to go ahead and plot the top marginal income tax rate in the US from 1913 all the way to 2015. So here we have figure 15.7 from your book. And it's important to note that this figure shows only the top rate. It's still a good indicator, though, of the general level of rates over time. So a few key historical dates. In 1931, during the Great Depression, marginal tax rates were increased significantly to about 80% by Presidents Hoover and Roosevelt in an attempt to balance the budget. In 1963 and 1981, major downward revisions occurred. And in 1993, President Kennedy lowered the top rate from 90% to 70%. In the 1980s, President Reagan lowered marginal tax rates further, and by the end of the decade, the top marginal rate was 28%. In 1993, taxes rose to 39%, and in 2003, rates fell to their recent levels, which are 35%, as a result of urging by President George W. Bush. We're going to go ahead and wrap up this video with a practice what you know question. So income taxes in the US can be described as what? And the correct answer here is progressive. Progressive taxation just means that higher incomes are charged higher tax rates. Your first few dollars are taxed little, if at all, but marginal dollars or additional dollars that you earn at higher income levels will be taxed at higher rates. That's going to go ahead and wrap up this video. If you have any questions, please feel free to reach out. Otherwise, I'll talk with you in the next one. Thank you.